Good morning, everyone. I'm Greg Faranello, head of U.S. rates for Amerivet Securities, and welcome to Monday Minutes. This morning, I'd like to talk briefly about the repo market and some of the distortions as of late. We wrote in our weekly piece on Friday that we feel the Fed has a three-pronged issue here. One is the trigger, right? What was the trigger that created the imbalances in the market a couple of weeks ago to send secured funding rates to levels where, quite honestly, they shouldn't have been at, right? So there was a confluence of events that required an extreme amount of cash out the door. Lack of response. Why wasn't this excess cash in the system released? And a lot of that has to do with the regulatory changes that we've seen, again, coming out of the financial crisis. The Fed has referred to these regulatory changes repeatedly, and in fact, Chairman Powell, when questioned at the last meeting about some of the liquidity ratios, said he would favor raising excess reserves on a short-term basis and less so addressing the actual liquidity ratios in the marketplace right now. And then there's market structure, right? An extreme concentration of cash. So the Fed's mandate is to increase aggregate reserves, but where those reserves actually wind up can, in many cases, create imbalances in the market between cash and collateral. Coming out of the global financial crisis, the Fed moved to a system of ample reserves, right? Interest on excess reserves and overnight reverse repo, right? With the intent to keep the Fed fund market within the effective Fed fund rate within a certain band. Now, also keep in mind, the Fed fund market in it by itself has shrunk over the last 10 years. And when you look at average trading volumes now, really the repo market is where you see the bulk of the volume. And this is a big part of the reason why the regulators actually chose SOFR as a replacement for LIBOR, because of the transaction-based nature of the repo market. So what do we think going forward? We think the Fed's going to have to expand the balance sheet, right? And on a practical basis, we think it makes most sense for them to do that at the very short end of the curve. If you look at excess reserves, somewhere around March, when we broke through 1.6 trillion down to close to 1.3 trillion, signs of stress in the marketplace were showing. So we think the Fed will need to get excess reserves up above at least 1.5 trillion, but between 1.5 and 1.7. So we see a balance sheet expansion to start at the upcoming October meeting of somewhere in the range of 250 billion. In conjunction with that, a standing repo facility, the ability for market participants to exchange collateral for cash when those imbalances exist. Something not designed to be used on a daily basis, so with rates set slightly punitive, but available for participants to use in signs of stress to alleviate distortions in the marketplace going forward. I'm Greg Faranello, and this is Monday Minutes.